Life insurance is a financial tool designed to protect the people who depend on you. In its simplest form, it's a contract. You pay premiums to an insurance company, and if you die while the policy is in force, the insurer pays a death benefit to the beneficiaries you name. That benefit can replace lost income, pay off debts, cover childcare and education costs, fund final expenses, and provide financial stability during an emotionally difficult time. Life insurance doesn't exist to make tragedy profitable. It exists to prevent a tragedy from turning into a financial collapse for the people you love. The first step in understanding life insurance is clarifying why someone needs it. If nobody relies on your income, you may not need much coverage beyond enough to cover funeral and final expenses. But if you have a spouse, children, aging parents, business partners, or shared obligations like a mortgage, your death can create a major financial gap. Even families with savings can be vulnerable because savings may be earmarked for retirement, and draining them early can permanently change long-term security. Life insurance is most valuable when it covers risks you can't reasonably self-insure, especially during the years when obligations are high and savings are still building. Life insurance generally comes in two main categories: term life and permanent life. Term life covers you for a specific period, commonly 10, 20, or 30 years. If you die during that term, your beneficiaries receive the death benefit. If you outlive that term, the policy expires. Term insurance is typically the most affordable way to build a large death benefit, making it popular for income replacement during working years. Permanent life is designed to last for your entire life, as long as premiums are paid. It usually includes a cash value component that can grow over time. Permanent policies tend to be far more expensive than term policies for the same death benefit because they combine lifelong coverage with additional features and costs. Term life is usually straightforward and is often the best match for people who want clear, efficient protection. The main decisions are term length and the death benefit amount. Term length should align with the years your financial responsibilities are greatest. Many people choose a term that lasts until their children are grown, their mortgage is substantially paid down, or they reach an age where retirement savings could support a surviving spouse. The death benefit should reflect what your family would need to maintain stability. That often means replacing years of income, paying off major debts, and funding near-term needs like childcare. The most common mistake is buying too little because it feels like a lot. The more useful question is, if I died tomorrow, how many years of financial runway would this create? Permanent life insurance is more complex and should be chosen for a specific reason, rather than defaulting to it. Permanent policies include forms like whole life and universal life. They typically have a cash value that grows, and you may be able to access that value through withdrawals or loans. The appeal is lifelong coverage and the potential for cash value growth. But the trade-offs include higher premiums, fees, and long-term commitment. Permanent life can be a good fit for certain situations, providing for a lifelong dependent, covering estate planning needs, or funding buy-sell agreements for a business. But it requires careful analysis because the policy's performance depends on assumptions, and early surrender can be costly. A critical component in life insurance is underwriting. Insurance companies price policies based on risk, and they estimate risk by evaluating age, health, lifestyle, and family medical history. Smoking, for example, can dramatically raise premiums. Certain medical conditions or high-risk activities can also affect pricing or eligibility. Underwriting can involve a questionnaire, and in many cases, a medical exam that checks metrics like blood pressure and lab results. Some policies offer simplified underwriting or no exam options, but those may have different pricing. In general, getting coverage earlier while younger and healthier often results in lower premiums and more choices. The way you structure beneficiaries is just as important as buying the policy. Beneficiaries are people or entities that receive the death benefit. You can name primary beneficiaries and contingent beneficiaries. Primary beneficiaries receive the payout first, and contingent beneficiaries receive it if the primary cannot. It's essential to keep beneficiary designations updated after major life events like marriage, divorce, births, and deaths. Beneficiary designations typically override a will, which means outdated beneficiaries can create outcomes you didn't intend. Also consider the practicalities of naming minors. In many cases, minors can't directly receive large sums without a legal arrangement, so families often use a trust or guardianship structure. Another important feature is the contestability period, which is typically the first couple of years after a policy is issued. During this time, if the insured dies, the insurer can investigate whether the application was truthful. This is meant to prevent fraud, not to deny legitimate claims, but it underscores why accuracy on the application matters. Even unintentional omissions can complicate claims. The simplest protection is to disclose everything as clearly as possible. Riders are optional add-ons that modify how a policy works. Some riders provide flexibility or additional protection. An accelerated death benefit rider may allow access to part of the death benefit if you are diagnosed with a terminal illness. A waiver of premium rider may keep the policy in force if you become disabled and can't work. Many term policies include a conversion rider, allowing you to convert to permanent coverage without additional medical underwriting. The value of riders depends on your situation and budget. The key is to choose riders you understand and that solve a real problem for you. Life insurance is often confused with investing. While some permanent policies build cash value, life insurance should generally be chosen primarily for protection. Investing is about growing assets over time. Life insurance is about transferring a risk you can't afford. For many households, a strong strategy is to buy an appropriate amount of term coverage and invest the difference in cost between term and permanent policies into retirement accounts or other savings. That approach can build wealth while still providing protection during the years it is needed most. Permanent life can be useful, but it should be part of a broader plan and not a substitute for basic savings and investing discipline. It's also important to match coverage to your actual obligations. A common approach is to estimate the years of income you want to replace, then add debt payoff and major future expenses. For example, some families want enough to pay off the mortgage so the surviving spouse can keep their home. Others prioritize a living income stream that supports the family's lifestyle. Many people also want a buffer for education costs or childcare. A good plan is realistic. It doesn't assume a surviving spouse will immediately increase income, and it accounts for inflation and the possibility of changing needs. Life insurance needs evolve over time. Early in adulthood, the biggest risk might be covering debts and helping parents with final expenses. As families grow, the need often peaks when children are young and a mortgage is high. Later, the need may decline as retirement savings grow and debts shrink. This is why many people reassess coverage every few years or after major milestones. Life insurance is not a set it and forget it decision for life. It is a tool that should match your current stage. Ultimately, life insurance is about protecting your family's choices. It can give them the ability to grieve without immediate financial panic, keep the home, maintain stability, and preserve long-term goals. The best policy is not the fanciest one. It's the one that provides meaningful protection at a cost you can comfortably sustain, with terms you fully understand, and with the beneficiaries set correctly. When it's designed thoughtfully, life insurance becomes a quiet form of responsibility, one that matters most when it's needed and is invisible when it's not.